Ladies and gentlemen, the crypto space. We're live on a Monday, December 12th at 11:30 a.m. So, we're in a period of austerity. We're in a period of deflating currency availability. It's a draining liquidity environment, and this is the most important time to appreciate what we do, why we do it, and how the system works. So, we've come a long way over the years in trying to better understand the systems we're engaging with. And we've also significantly discussed the broader macroeconomic system. And clearly, none of us are industry veterans, but we've been exposed to a tremendous amount of information that historically we would have never had access to. And obviously, with social media, we've had not just like a single source of information, a single educational resource, but opinion, commentary, and experience from very experienced person, industry veterans to say the least, new people that have learned over the years, just as us. And all of this has culminated in definitely a very valuable and meaningful perspective on not just the markets we engage with, but what we do in our lives and the construct of society as a whole. Clearly, it's a very philosophical introductory couple of statements, but that's what we do in DeFi. We talk about incentive systems. It's what you're here for. You're here. We're on this stream at least. We're talking about yield, cash flow, enterprise, and this is stuff that people have historically pursued in the equities markets, and clearly this is what enterprise does, is what banking is, and this is what financial management and the hedge funds do, especially like retirement funds and passive income funds, so on and so forth. And to understand really how to navigate this market, I'd like to refresh everyone the basics of incentives and why we do what we do. We are human beings. We are born with nothing. And we like to think that everything revolves around currency and money. And sure, that is the case. But the most important thing to understand is everything reduces to commodities and consumer staples. Let's say we're 500 years ago and everything was scarce. There was no activity really, like opportunity with regard to business, access to the abstracted financial layer atop the fundamental. The fundamental is compensation. The fundamental is you need food and you need water. Now, obviously, if you don't have food and water in the surrounding environment, or maybe someone controls it, you're pretty much going to do something and hope to be compensated in food and water. You are incentivized to do something in exchange for something you need. Now that's the basics. Now that's everything. So if you have food and water, you work to get it, and what society has built is an abstraction layer on top of it. Now, it's obviously a very high level couple of statements, but that's the most important thing to remember. We pursue consumerism and we pursue the accumulation of stored credits. That's kind of what like a currency is. Obviously, currency is designed to organize labor, and the notion of savings, that's a very abstract notion. It's like I did work and I'm going to store the work that I did in the past to use that stored labor in the future. So it's certainly an abstract concept that doesn't exist in at the base layer, which is do work, get compensated in food or water to stay alive. So, so currency units and compensation that evolved over time, so we could start to organize and take things to a more sophisticated level. And clearly, in the last 100 years, it's gotten substantially more sophisticated to the point where we have these incredibly sophisticated derivatives, options, and financial products and services. And it's a very intimidating thing to try and understand. But it's imperative to understand where we started at the base layer to where we are now. High level, we are talking about incentive systems, talking about the base fundamental need of an incentive, incentivized to do work, get food, and water, clean water. Seriously, how many parts of the world do you not have access to the clean water? And that's literally something that's on the forefront of everyone's mind on a daily basis. So literally, we're talking on the stream today about the accumulation, the opportunity to engage with enterprise, to accumulate savings, or to accumulate this abstracted concept we call a currency, so that we can use it to buy the food and water. It's a stored form of labor. What a fascinating topic psychologically, and it's difficult to really dig in to fully digest what it means. And really, it plays a role in our morale and our demeanor and our capacity to engage with society on a daily basis. So, what I find great solace in is understanding that basic base layer and what it really means relative to where we are in these systems that have been created. So, we could talk about DeFi because that's why everyone's obviously here. This is a crypto-centric conversation. Um, and this is an interesting page that kind of sparked a couple of thoughts this morning. There's not many things that are solvent in the DeFi space. The incentive systems are not positive sum. For these incentive systems to effectively incentivize capital to flow in, they need to compensate. They need to compensate a person past a critical threshold, and that's not occurring. So this is a very much a negative sum environment. Um, it's not the clearest thing to understand, but a great way to understand financial markets is fluid dynamics, water flowing into a system and out of a system. So uh, you could do a lot of modeling with regard to physics in many regards, and this manifests really in emerging market capital flows. So there's a lot of capital in the system. It's always flowing, and it's flowing into and out of the DeFi space. Why? It's flowing because of incentive systems. Now, we're not talking about capital gains and adversarial trading. That's a whole nother ballgame. But the vast majority of finance operates with regard to yield, interest, and access to enterprise cash flow. And that's why someone buys a stock. Someone buys a stock because the dividend's paying 3%. Someone buys a bond because, the 1 year is paying, 4.7%. That's why a person is incentivized to purchase something, because they're going to be compensated for it. And there's very little reason to purchase almost anything in the crypto space. Now, these are complicated calculations because it's what is fascinating about DeFi is it's not just a dividend from the cash flow that the enterprise experiences. So, for instance, cash flow positive enterprise is paying a 3% dividend, but that's not just the case in DeFi, because there's the federations that I've talked about, and it's not the enterprise's cash flow that's paying the returns that we are receiving. So there's that's a further abstracted construct on top of the already abstracted financial construct, on top of the traditional abstracted financial construct, on top of the base layer. So that's why DeFi is so intimidating, because it is a very abstract of an abstract concept. I would hope you guys have a couple of questions on this topic. I could help you guys understand it as I try and understand it. But I'm not too enthusiastic about the cash flow availability in the DeFi space. Now, obviously, forward-looking, I have a high opinion that capital will flow into the system because of its permissionlessness and its global scale and scope, as well as concepts of decentralization and disintermediation. But as I've said, we're in a period of austerity, so capital is still flowing out Let's jump over here real quick. I'm going to go back to that screen so we can continue to digest that thought. But let's go over to stables real quick and see where we are with regard to liquidity. Still minus 0.33. So it's not like a tsunami of capital outflow, but it is a constant stream of capital outflow, at least greater than inflow. Now, we see on Twitter that there's a fair amount of minting on Tether and USDC. So there is inflow, but it's net outflow. So it's still a negative sum environment. And the negative sum environment manifests in the potential solvency and cash flow positive state of various protocols. Now look at Ethereum as minus 4.8 million. Now obviously this website that they put together is APIs that have a particular implementation. So I would assume that the fees versus revenue, this is transaction fee revenue versus fees revenue. What's the difference between a fee and a revenue with regard to Ethereum? So incentives would be the issuance from staking, and the revenue would be the fees from transaction fees. But that's fees. So this is obviously convoluted or not entirely clear what the values represent, but this is about right. If you're minus 4.48 million, and we have barely any inflation, so that basically means there's only a little bit more issuance relative to burn. So it's a very neutral situation for Ethereum. If we go back, and this plays into like digesting. You don't necessarily need cash flow positive with certain protocols. Like the whole point of Ethereum is for it to be neutral. You want the income to equal its expense, and that is optimal. It's obviously more favorable for the burn, the consumption of transaction fees to be greater than the issuance, and that creates a deflationary the state of the monetary policy, but at least neutral. And this is relatively neutral. I mean, how much has Bitcoin issued in the last year? We could actually see that if we go over here. 3.58% on what's the market cap of Bitcoin. That is a very large amount of issuance. So that is a very negative number. I don't think Bitcoin is here. 426 million. So Bitcoin is 100 times worse with regard to cash flow than Ethereum. I mean, at least these numbers are right here for everyone to see. Minus 426 million, and Ethereum is minus 4.8. Now, the kicker is, with Bitcoin, the transaction fees are not burned, so there's no way to offset the expense they have with the issuance, the mining reward, other than market actors purchasing. And then this whole topic is about incentive. So what's the incentive for persons to purchase Bitcoin if it's a net negative cash flow situation? And this is where the complexity of digesting this entire market comes in, because they're ancillary incentives. The incentives are decentralization and the narratives that are pervasive in social media, and that has historically created incentive cycles, and that's what we see. The rainbow chart and the various peaks and troughs of the price point, and we talk about the correlation with the interest rate cycles and equity markets, so on and so forth. But as I would like to reinforce more and more into the future, it all reduces to incentive systems. So the point being, probably one of the best points, is that Bitcoin is significantly more burdened to effectively incentivize purchasing as compared to something that like Ethereum, that has a better presentation from a balance sheet perspective. At least from a balance sheet perspective, that is something that is attractive to traditional financial market actors. If you're a traditional value investor, You're looking at the balance sheet and you're like, is this enterprise solvent? What's their cash flow? Is it cash flow positive? What's their dividend rate? So, for instance, Ethereum has a dividend rate. It has a significant amount of cash flow. It's pretty darn close to cash flow positive. And then you're like, what's the potential for insolvency? And clearly that's not applicable. In this instance, it's more akin to inflation and deflation and a monetary policy as compared to a business balance sheet. But these are the types of things we look at to try and understand the nature of these abstract financial constructs that have emerged in the DeFi space. Um, these incentive systems. And incentive systems are a part of digesting what the heck is going on here. So I like these numbers. I like this data. And I think it shines a little bit of a light on what the heck is going on here because you want to see cash flow. But look, for instance, here's a great example, DYDX. Who gives a shit what its cash flow is? Its cash flow means nothing with regard to incentive to purchase because you get paid nothing. It offers you nothing. Why purchase it? There's no reason to purchase it. We're going to completely neglect the concept of adversarial capital gains. Why purchase something that pays you nothing? So without that component, without a share of the cash flow of the business, there's literally no incentive to buy any of this shit. GMX, obviously, obviously these numbers are here, but they warrant due diligence. So we're not going to dig in, but we are inclined to think GMX is quite cash flow positive, but I guess they do have a fair amount of issuance. 7.8 mil. Okay. It is what it is, at least presented here. But it gets complicated because of the complexity of the constructs that these DeFi protocols have created. There's locking, there's escrow, there's vesting periods, there's capital controls. And these all play into the calculation that we have to do to understand the incentive system that has been created. A derivative financial construct with sophisticated incentive systems designed entirely to encourage participation, encourage capital to remain in the system rather than leave the system. So you know how I've said that in many regards the crypto space is an emerging market? Great. That still is the case very much. And we see that in the llama. This is how you look at the entire crypto space as an emerging market, capital inflow versus capital outflow. But then each protocol, in many regards, is like an emerging market. So DeFi, in many regards, is an emerging market of emerging markets. Now, you don't have this dynamic really with equities, albeit you can talk about like share issuance and buybacks as like monetary policy, and you can maybe try and look at it as a currency, but then you realize that it's controlled by a board. So then you'll say maybe like the Fed does the exact same thing, where human beings are in control of issuance and removing shares or currency units from circulation. But what's nice and refreshing, at least about the DeFi protocols, is that these are, or the optimally implemented ones are deterministic in nature. It's not like you're dealing with humans and modifiable, not necessarily arbitrarily, but optimally, at least in a predictable way, at least with governance and on chain so that you know what's going on, why it's going on, when it's going on. And that's a significant advancement over traditional systems. Flashbot is interesting, showing some green. You'll note that Curve's on here somewhere. Curve is quite negative, but this completely neglects the cash flow or the incentive that persons have for engaging with the system because of third parties paying people to enter the system. So the incentive is designed to draw capital into the market versus leave, and the incentive is either paid directly by the protocol or by third parties. Now, There's only a couple of instances in all of DeFi where third parties are incentivizing capital inflow. Isn't that fascinating? I mean, that's really the Curve Federation, the Aura and Balancer Federation, Velodrome over on Optimism, solidly when it gets released on mainnet, and I mean, GMX doesn't really have incentives, third party incentives, but isn't that fascinating? Because that's an incentive, but it's not paid for by the protocol, it's paid by third parties engaging with the features and functionality and dynamic nature of the protocol. It's offerings. So while this information here is very meaningful, there are additional nuances that go above and beyond the capacity for this information to tell you holistically what the hell is going on with the incentives for capital inflow. Well, we came a long way in the stream. From the base layer incentive of work for food and water to the storing of labor in the form of a currency unit so you could spend past labor in the future to these very high level sophisticated financial constructs where there's much more sophisticated incentive systems to engage. It's not just work for food. It's participate because other people are participating, and it's a whole not it's whole it's a whole experience. It's a group shared experience that transcends in many regards historical systems. You know why? A good part of why this is something that is new for us to digest, because in many regards we've never had access to anything like this. A lot of the things we talk about are traditional financial constructs that, banks and governments have had to consider, and these structures have been recreated and iterated on in many regards in these smart contract implementations. I mean, how often before DeFi in 2019, we were not talking about emerging market capital flows, but clearly persons in traditional finance were macro folks that make those kinds of bets on FX markets, and that they're speculating on capital rotation into and out of commodities and gold, silver, bonds, so on and so forth. But we have seen the creation of systems in DeFi that mimic attributes of those traditional financial market structures, but are much more sophisticated in many regards. I mean, literally, interest rate derivatives, IPOR. I mean, come on, though. You're talking about a 600 plus $1 trillion market, and there's folks in software, smart contracts that are implementing analogous instruments. And MakerDAO appears one of the originals with regard to a CDP. And the only thing in traditional finance comparable to that is Eurodollars, and that still to this day is a completely opaque market that few people really understand the breadth and reach of it. But that is what it is. It's a lending protocol. It's not something you go to a mortgage or you get a car loan. That's not something the average person processes, but we have to process it because we have the potential here to understand systems that have a capacity to impact our lives in a financially positive way. It's a great opportunity, but it's very intimidating and very complicated. But it's worth every effort that we expend, either me talking or you guys listening to me or what have you. We try our best to understand these systems. Anyway, who's in the stream? Got Raoul's in the house. Tapsy, Killis, Ding Ding, a pleasure. Crypto Jake. What are your thoughts on Ren? Is there hope? I don't believe in hope. I believe that there is a fair amount of software that was created. I believe that software will be deployed some way, some shape, some form, some time. And that's it. I have no interest in pressing the unbond button, and I will be here to see what plays out. I will have those nodes operating, and they will do what they're going to do, whatever it might be. That's how I'm approaching the situation. Gazik is in the house. Hello, Noah. Hope you're good in these times. If you had any spare cash in crypto, where would you put them to work? I would put them to work saving them for egg sandwiches. This is not a time to think about investing. This is a time to be watching liquidity inflow and outflow. This is a time where you can expect everything to depreciate. There's no expectation of appreciation or remotely decent, yet alone significant appreciation anytime soon. And I expect the yields to continue to dry up as volume continues to decrease. It's risk off. This is very risk off. When you see liquidity go up 1%, 2%, 5% a week, that's a different story. If you ask that question, Gazika, in a time where you see 5% on this number, it's a whole different answer. So I've said it before and I'll say it again. Now is the time to appreciate any capital inflow that you have. This game is scored in dollars. You want dollars to be able to buy an egg sandwich. This is not a time where you're going to change your life with an investment. This isn't bottom. That is what it is, and that's boring from a crypto YouTube channel, but that's the way it is. And I guess few people will tell you that, but that's something that I have to say. I'm not doing anything. I mean, I do have cash that I do consider for investment, but the yields are not tantalizing enough, and I expect the yields to go down. So, bonds are a consideration, but what if inflation is persistent at 5, 6, 7%, and the whole system is going through a transition to some sort of new paradigm? I mean, seriously, there was a time in 2011 where everybody was talking about the 40-year trend. Let's go out to the monthly. And we literally broke a 40-year trend line, that white line. So there's you can't necessarily expect a return to bonds risk on. They haven't gone risk on yet. There's no significant risk on. There's no significant risk off in equities. And somehow everything seems magically stable. We've had some contagion in the crypto markets, but we haven't had any significant contagion, liquidity events in traditional finance yet, and that's pretty remarkable. I mean, the interest rates aren't that high, but this is not a time to tempt fate. This is the time to be patient and watch and learn and understand and see what survives. Because frankly, whatever survives this shit to the next time where there's actually decent liquidity inflow into this emerging market that we favor, whatever survives is going to have one heck of a track record in history. It's going to be the name that all the new people that know nothing are like, oh, that was around in 2020. It's been around all these years, and that's meaningful. So this is a time to see what survives. Hope that helps. Hilda's in the house, a pleasure. Crypto Jake, so it's still earnings positive as these are more like dividends or stock splits kind of versus equities compensation until token terminal differentiates these. I believe it's somewhat misleading. Yes, I agree. It is somewhat misleading, but it's generic. It's very high level, and it doesn't consider the nuances of the respective platform. Because look, you're talking about an AMM, and there's persons that are providing liquidity that are generating cash flow. I guess this is very much a presentation that's looking at it from a company perspective. Are they cash flow positive? How much is the protocol making versus how much the protocol is spending? So this is like a presentation that's useful from not a value investor playbook. Where this is people looking for maybe solvency. Is the company capable of maintaining operations, or because no one's going to buy something that's minus 25 million in the red? The solvency concerns there. Where are they getting the $25 million? And that's on a monthly basis. I mean, look at these, minus a half a bill, 700 million. Horrible. I mean, OpenSea looks great. So OpenSea doesn't. They do have the revenue share, the creator fee. So for the persons engaging in the OpenSea is a very sustainable operation. That's what this shows. That's very interesting. So they have a lot of cash flow as a business, and the creators have a platform to market and sell and distribute the content that they create. So this is actually very a presentation that's very supportive of what OpenSea and what NFTs really are from a content creator standpoint. Now that's actually very interesting for MakerDAO. MakerDAO has been always one of the more prominent cash flow positive crypto operations. Now, clearly, there's a whole discussion to be had and why it's not even a remotely reasonable investment opportunity because partially it's monetary policy, disintermediation of cash flow. It's not a good investment. Great tech isn't necessarily a good investment. I'm not going to go through all of them, but that's the complexity. There's a story about all of these, and the story about all of these is much more sophisticated than the relatively simple story of an, an equities market balance sheet evaluation. Because here we're dealing with monetary policy and incentive systems that are not just disintermediation of cash flow, a dividend, but incentive systems that are financed by third parties. Why the hell would a third party finance or finance an incentive for capital inflow to purchase an asset? So that's something that's very novel as compared to traditional finance. You got to remember when you go over here, when you see the market for incentives, the largest incentives are by far for Curve, really. Albeit if you go over to Hidden Hand, these incentives are nice as well. But these are third parties, and this is even further complicated because a good part of this is the transaction fee revenue from the LP position. But a lot of this is also third party. A third party is paying people, and because they're paying people, it incentivizes people to go over and look at the price of Aura and be like, okay, maybe I will add capital. I will put liquidity into this market, and the liquidity will go in because of a third party actor and their actions in the ecosystem. So that doesn't have any precedence whatsoever in traditional finance. Third party incentive systems. More lobby, hello. Hilda Cap, I had some hiccups with Curve, gauge weight voting, do resets of voting, get processed the end of the week. 10-day period. I tried a couple of times with pretty less. So there's a 10-day period on gauge weight voting. So you go over to the DAO and you go to gauge weight voting. So once every 10 days, you could go down here and hit the reset button. You could hit reset. Boop. I'm not going to do that. Reject. And then you could vote accordingly. And, the incentives are drying up. Warden has some good numbers, some good incentives over here. But I believe they're full. Let's go over to Quest. Yeah. Uh, so it looks like they topped up. So another 2 weeks for T and POW. Um, so T is empty. POW has 83% full. There's a quarter million votes that Paladin is looking to rent that's still available, paying 25.67% return on the money. And if you go over to Stake DAO, I expect Curve to re-up their balance, so they continue to rent their votes. But 30% is pretty cool. Um, there's the Warden, but those are all empty pretty much. Although the quarter mil and the Paladin, Abracadabra is still running some big numbers. I don't entirely keep up with their entire story and what the hell's going on over there, but they understand how much more capital efficient it is to rent votes as compared to just purchasing more curve. It's just that's the whole notion of rentals, and that's why this is such an interesting system that has been created. And look, I mean, there's $250,000 a week. That's $1 million a month of protocols, third parties renting, incentivizing participation for in these markets, incentivizing liquidity inflow into these respective markets. And that's what this is. Going to opt for Warden WFT. Bear in mind, don't forget to look at the availability. There's currently no availability for WFT. There's no remaining votes available, so don't vote for WFT. Paladin has 250,000 votes available right here, so you can get 25% of the money paid in PAL on 250,000 votes. Hope that helps. And these are open-ended, so these don't have a cap, but they obviously dilute. So this was at 34%. This morning it's at 30. So as more votes are applied to this rental incentive, the yield is divvied up proportionally. So that's how that works. One curious view: have you seen Sam Frax thinking about FRX USD dollars in a Fed account? Well, isn't that a next step? That's what USDC is looking for with regard to that BlackRock talk we've heard. What's the odds of somebody getting access to an RRP account with a Fed account? It is what it is. Obviously, it's very interesting, and I would very much like access to the RRPs. Bank accounts, you're not getting shit, and I'm not too keen on putting my cash into a bond. I need to be able to spend it, and I'm not. It's not like I once said I wanted a prepaid debit card where I could put 1-year bonds. But the problem is they're not incredibly fungible. You could sell one at a time, but what if you want to make a micropayment? $1, $2, $3, $4, $5. So I'd be very interested in having 3-4% RRP rate on dollars. I mean, come on, that's quite interesting. Until then, I'm more than happy to sit in a stablecoin for a variety of reasons. So that's cool. Fugu, I wonder, where do you get your philosophical knowledge from, Noah? What inspired you to think this way? I don't know. I just wanted to understand these systems. And when I was in college, I always saw analogy. And I like to model things. I like to model something in terms of something else so I could understand that something. And obviously, everything in the crypto space is modeled after traditional financial constructs. But what happens is, once you try and put the crypto space into traditional financial terms, you're like, oh shit, it's like that. But they iterated and did something new and interesting and novel, and there's no analogy, there's no comparison that can be made to something else. And that's innovation. So, it's not, innovation isn't enough to outperform a period of austerity, a period of deflation. So that's what we're doing here. What we're here trying to do is understand the innovation, because whatever survives, whatever has innovated, has a potential to survive, and we're looking for that attribute. And if it has the attribute of survivability and it does survive, it builds the lindiness, and therefore it is more likely to outperform in future emerging market capital flow cycles. So what I mean by that is, when capital starts to flow back into the crypto space, what are the things that are going to outperform? There's shit that survived. That's what outperforms. So we're here discussing the shit that has the potential to survive. And we're being a little critical of protocols that maybe spend too much with regard to their token issuance. We've seen, obviously, hyperinflationary catastrophe over the last 2 years. But in many regards, there's few protocols that are actually decent. And that's what's stark. What's surprising maybe to many is maybe 6 to 12 protocols in all of crypto that even got it remotely decent. So be be very prudent, protective, careful, and remember to always think in terms of egg sandwiches because in the morning you want to be able to buy an egg sandwich. And Bitcoin is cool and all, but buying an egg sandwich at 6 a.m. is better. So just remember that. More lobby, been out of the space for a while. What's the major things going on? Seeing curve is still going strong. We're in a period of austerity. I'm not going to go too much further down that rabbit hole, but this is a market where capital is flowing out. I look at this space nowadays as an emerging market, which is like a country, and capital is either flowing in or flowing out. And in traditional sovereign land, that's done because of natural resources and import export trade balance. And that's done in the crypto markets because of technological or financial services offerings. Clearly, in the NFT space, that makes sense. It's a product. Maybe it's a cards in a game like Gods Unchained. That's why capital flows in, so someone could have a card and play the game. Maybe it's the capacity to collateralize. So 100 mil flows into Aave because they could borrow $25 million in USDC and USDT, and they're able to leverage accordingly. So the permissionless nature of the market is going to encourage capital to flow in, and then the whole relative strength or weakness of the market is net flows, net inflow versus net outflow. But what's fascinating is that there's a lot of sticky capital. There's $141 billion worth of sticky capital that has been captured by this emerging market. So these contribute to attributes of survivability. And then we dig into each individual protocol to see which discrete components of this market have the strongest attributes of survivability. Hope that helps. Um, what I miss? What I miss? Could you recommend a book on philosophy and investing? I got nothing, my man. I don't honestly read much. I obviously read on the on the internet. That's where I get the majority of my information. A lot of my information is for introspect, self-thought, and just documenting my ideas either on social media, verbalizing them with myself, friends, and family, some writing here and there. But I don't have any book recommendations with regard to the way I think. Um, Maybe one day. Thanks, Cap. MIM3 Curve seems to bring the most rewards besides Warden when still available. Well, it varies. Bear in mind, these are dilutable positions, so there's no cap to the participation in these positions. So if someone comes in with the 5 million curve votes, it's going to be down to 15-20%. So these will dilute. There's 2 days, 12 hours left for further dilution. And that's the game. The vote market gives you a presentation that includes the warden. Now, bear in mind, look, it says right here there's 0 remaining votes for T, and no, that's remaining rewards. So you do have to go to the warden to see how many votes are remaining, and every week you want to understand who you're letting rent your votes because different protocols, different market actors will rent your votes for a different rate. So this is how you manage your portfolio. I hope that helps. So keep an eye on the vote market as well as the warden to maximize the productivity of the portfolio. Angelo, a pleasure. 59 million token incentives on Ethereum. This is the last 30 days. Yes, $59 million. Now, bear in mind, there's been barely any inflation. You're talking since merge, 5, 7, 30 days. So there's been a supply change. There's been 7,000 more Ethereum created over the last 30 days. But if you go to all time, can I go back to all time? Oh, since the merge, 88 days. The net change in total supply is only 1,000. So this is it's a little myopic, it's a little too concentrated, and it doesn't have any of the narrative and discussion that could take place about this data versus other pieces of data that give a bigger picture about what the heck is going on. So basically, Ethereum is receiving in transaction fees and burning just as much as it is paying for miner activity or proof of stake activity. Um, that's what that basically means. Dan's in the house of pleasure. Rather than Aave, would you utilize Frax Land? I like Frax. I have no interest in borrowing. I don't like to borrow money. I believe in very much a debt-free life, so I don't like to borrow money. Um, that's just that's just me. But Fraxland is cool tech. Aave is obviously, one of the Lindy protocols that's going nowhere. They got issues with regard to interest rates. How the hell are they going to compete with 4.7% on one-year U.S. bonds, T-bills? Or those are treasuries. I think T-bills are less than a year. Anyway, but there's risk associated with the protocol as compared to 4.7% on a one-year treasury, and you're like, oh, that's risk-free. That's literally risk-free. So, there's very much reason for not capital inflow into Aave, albeit there will be capital inflow because of the capacity to collateralize permissionlessly and borrow. The interest rates suck. So there's obviously plenty of psychology that goes into why would someone expose to Aave as a lender when the interest rate sucks? And this it's a big planet. Maybe a person with capital doesn't want exposure to risk-free U.S. bonds because of maybe their geographical location, maybe the nature of their enterprise, maybe the nature of just how they manage their capital and its diversification. So even if it's not optimal from a cash flow perspective, there's still plenty of reason to remain engaged with the market, and that's exactly what we see here. It's $141 billion in the market, and that's because it's dynamic. It's an entire conversation to understand why someone would or would not be incentivized to keep capital in a market. It's not black and white. Richest Man of Babylon, Peter, good recommendation. Have you looked into Grail, Camelot, and Arbitrum? Yeah, I have, but not interested. I need more Lindy. I need shit that's been around. I don't want a new protocol. I'm not that type of market actor, and I will underperform many other people that take more risk. And that's okay, and I'm okay with that. Warner is cool to be passive at AF. That's right, Hilda. Voting earlier than forget. No need to compare dilution or anything. Yes, if there's availability and things get annoying, if one of the persons renting votes stops, then you're like, oh, then you have to change allocation. But there's perks to these two systems, and I think this is just tantalizing at the potential of what these systems could be. This is all beta shit. Everything is just beta. It's just like a first pass at something that actually works. And somehow this shit captured $141 billion, so that's quite fascinating. Angelo, they meant POS words. Yes, POS rewards, that's correct. Dan, there's an AMA with Umami and Camelot tomorrow. Looking forward to it. Keep us posted to the forum. We're all very interested. We know Crypto Condom likes Umami, and I mentioned Camelot. This, as I said, this is not a time that I really have any interest in speculating or deploying some sort of capital to hopefully generate revenue. I just want stability, and that right now these conversations that we have help greatly in me understanding this period of austerity, that I shouldn't be looking for excess risk. I need to be protective, and we want to understand this market for what it is, because there will be a period of time in the future where we've positioned ourselves well in this period of austerity, and those positions are going to significantly outperform when liquidity starts flowing in, because these are the positions that survive the austerity. The Risk off positions in crypto are the ones that are going to outperform a lot in the next liquidity cycle because they survived and because they're building trust and because they're functional and offering a service to people that isn't exposed in traditional finance, and that's meaningful. Ladies and gentlemen of the crypto space, thank you all for joining me Monday, December 12th at 12:19 p.m. Tell everyone to subscribe because if they don't listen, I can't help them do better, and we all can do better. After party on Discord for the most rational community in the entire crypto space. Appreciate all of you in there. We all try and do better together, and there will be a time when we will be doing better because of it. Catch you next time. Peace.